Welcome to an episode of Real Talk Real Estate. Today we're going to be talking about what HELOCs are and how you can take advantage of them. My name is Lola. I'm your favorite realtor and I'm a licensed realtor in the state of Minnesota. My job is to make sure that homeowners, home buyers, and home sellers are educated throughout their home owning, home buying, and home selling careers. So now that we've got that out of the way, let's go ahead and get into it. First of all, what is a HELOC? In order to know what a HELOC is, you probably want to know what HELOC stands for. HELOC stands for Home Equity Line of Credit. But in order for you to understand what a home equity line of credit is, you probably want to start off by knowing home equity. So for those of you who aren't familiar with the term equity, equity is basically the current market value of your property minus any mortgages that you might still owe on the home. So let's run through an example really quick. Let's say that you bought a home for $275,000 and you've lived in it for a little while, you're just kind of chilling, and now you've paid your mortgage down to $225,000. So we're gonna take that current market value of your home, which is $350,000, and we're gonna subtract the $225,000 from it, and what's left is $125,000. That is your equity. So you now understand what the HE part of it means, the home equity part. Now we have to understand what the LOC part of it means, which is your line of credit. The line of credit you're going to get, or the amount you're going to get for your HELOC, is going to be based on what's called LTV. And basically, this is a ratio that banks use to determine how much money they're going to give you. And depending on the bank that you go to, plus a few other factors, it may be anywhere from 80 to 90% LTV. And all this means is that the lender is going to give you 80 to 90% of the value of your home minus any mortgages that you owe on it. And yes, we're going to go through another example. We're going to use the same numbers that we just used to figure out our home equity for this example. So we know that the current market value of your home is $350,000. And the bank is going to give us, we're going to use 90% LTV. So how we figure this out is we're going to take $350,000, multiply it by 0.9, 90%. And that's going to leave us with $315,000. Now again, they're giving you 90% LTV minus any mortgages that you owe. So we're gonna take that $315,000, and we're gonna subtract it by $225,000, which is what you still owe on the property. And that leaves us with $90,000. So the bank is gonna give you $90,000 for your HELOC. Great, so now you understand the HE and the LOC part, the home equity and the line of credit. So let's walk through how this home equity line of credit actually works. A HELOC can be used like a credit card. It's open-ended, so you can use and reuse it again and again. Now, you may think that you now know all there is to know about HELOCs, but keep watching because I promise you there are a few more things in here that are gonna be key to making a decision and figuring out whether a HELOC may be right for you. So for the first 10 years, you're in what's called a draw period, where you're only making interest payments. You're paying the interest only, you're not paying the entire principal or the entire amount of what you owe. So you can continue to use and reuse this line of credit over and over again like we talked about. So again, you do not have to actually make any payments on the amount you owe for the first 10 years. Now, the interest on a HELOC is calculated a little differently than what it would be on your mortgage. A HELOC does not have a fixed interest rate. On a mortgage, it doesn't matter if rates go up or down, your rate does not fluctuate, it stays the same. HELOC is typically an ARM loan or an adjustable rate mortgage, meaning it can change. It can change as much as day to day. And it is calculated using your average daily interest. How it's calculated is they're going to use your daily balance divided by 365 days, multiplied by whatever the daily interest rate is for that day. And that's what you're going to be paying on a monthly basis. Then after 10 years, any remaining balance typically becomes a 20-year mortgage with a principal and an interest payment, so you can pay down the balance that you still owe. Now, some things to keep in mind before you go out and get a home equity line of credit is that a HELOC is a second mortgage. It's going to sit as a lien on your property. It has interest on your property. It's using your property as collateral in the case that you should default. So your first mortgage is the balance that you owe, right? It's in the first position. And then that HELOC would be in the second position. The second thing you should keep in mind is that HELOCs are not all built equally. Different banks are going to have different programs, they're going to have different requirements, they're going to have different restrictions, rates, fees. So it's important that if you're looking for a HELOC, you do your due diligence and ask what all of these different banks have to offer. So we talked about a lot today. Let's go ahead and sum it up. A HELOC is basically like a credit card that you can use, reuse, pay off, reuse. It has a draw period, a repayment period, and uses your home as collateral. And it's important that you shop around before deciding which bank you want to get a HELOC with. Well, guys, that's it for Real Talk Real Estate today. I hope that you have better learned how this works and if this might be a good option for you. If you haven't already, make sure that you subscribe and you click the little bell so you get notified when I post new videos and so you don't miss any other tips, tricks, and information that I share on YouTube.